very simply, is how markets move, and it is a profoundly powerful concept. The fundamental pattern of market movement on all time frames is this: a movement in one direction, a counter-trend retracement in the other direction, and another leg in the original direction. Visually, these movements are often labeled with letters. This is a very rough schematic structure, but it is a powerful pattern that repeats on all time frames. Whether we look at trends on daily time frame or seconds, we will find this same impulse, retracement, impulse structure, though the psychological significance of the pattern will vary depending on the time frame. It is also reasonable to ask why this structure should exist at all, and there are several possible answers. Put yourself in the shoes of a trader who has to buy a significant amount of an asset in a very short time. Your primary objective is to get the order done without having a large impact on prices. How might this best be done? The best option in most cases is to buy a little bit, wait so that you don't move the market too much, then buy some more, and repeat until the order is completely filled. This is how good execution traders work large orders. Smart traders, or smart algorithms, will judge how to plan their buying by the market's response to their orders. In this way, they are judging the supply or the selling conviction hanging over the market. A single trader executing an order in a market otherwise composed of pure noise traders would create some variation of this price pattern by trying to fill a buy order through this natural process. Market prices are the result of buyers and sellers negotiating for prices, nothing more and nothing less. We do not need to invoke some mystical force to create the patterns we see in the markets. They are simply the result of buyers and sellers finding prices in a competitive environment. This is also why the fundamental structures in the markets have not changed since antiquity. A fractal is a type of pattern in which the parts resemble the whole. Markets are fractal in nature, meaning that essentially the same patterns appear on all time frames. Patterns on single-tick charts combine to form 1-minute candle. The patterns on the 1-minute candle are the same as those on the single-tick candle, and they combine to form the patterns on 5-minute candle. This pattern building continues all the way to daily, weekly, monthly, and yearly patterns, which all contain essentially the same patterns. The figure shows a schematic example of how this might play out in the market. Each trend leg is an impulse, retracement, impulse pattern, and each of those legs also breaks down into the same pattern on the lower time frame. Though only 3 levels are shown on the diagram, this structure theoretically extends down to the 1-tick level. Furthermore, the entire large structure in figure could be a setup leg for a trend on the next higher time frame. This is not an abstract concept, but an important tool to understand market structure. No pattern exists in the vacuum of a single time frame. Understanding this structure is a key component of building intuition about markets. Traders usually focus on one specific time frame, but it is important to understand that the patterns of the lower time frame actually create the patterns on the trading time frame, and that the patterns on the trading time frame are influenced by evolving patterns on the next higher time frame. In practice, the interactions of structures on lower time frames are usually components of price action, while high time frames are more likely to provide context or motivation for market structure patterns within the trading time frame. Trend structure. We now turn to the structure of trends in a little more depth. How they start, how they unfold, and how they come to an end. The presence of a trend suggests an imbalance of buying and selling pressure. It is this imbalance that actually drives the price change of the trend, and the trend will eventually end when the market finds equilibrium at a new price level. It is extremely important to be able to read the trend structure and to know what patterns support a continued imbalance, or what patterns indicate that the trend might be coming to an end. Impulse and momentum. The first leg, a B, of the basic structure is often called a momentum move or an impulse move. In an uptrend, this is a relatively sharp advance driven by buying pressure, demand, overcoming existing selling pressure, supply, and creating a lack of liquidity on one side of the market. After a market has been locked in an extended trading range with no clear momentum, the emergence of a sharp momentum move penetrating one side of the range is often a sign that there is a new imbalance of buying or selling pressure. Impulse moves drive trends. As long as each trend leg extends in a momentum move approximately consistent with previous moves, the probabilities favor buying the next pullback for another trend high, or, in the case of a downtrend, shorting the pullbacks for another run at the lows. What you do not want to see in a trend is the emergence of sharp contra-trend momentum on one of the pullbacks. Remember, the normal pattern in an established trend is that each setup leg is a momentum move, and the subsequent extensions also function as momentum moves, setting up the next trend leg. Economics 101 tells us that increased demand in a market will lift prices as the market tries to find a new market clearing price. This description of trend movement is one of the mechanisms through which that adjustment happens. Eventually, higher prices will bring enough sellers into the market that a new, perhaps temporary, equilibrium is achieved. Astute technical traders can usually see clues to this process in the market tape. The most important patterns are new momentum highs or lows, subsequent trend legs making similar new impulse moves, and the absence of strong counter-trend momentum on pullbacks. Climaxes. Buy pullbacks following an upward impulse move, or short bounces after strong selling impulse moves. That, in a nutshell, is a very effective plan for trading trends. Simple, right? Not so fast. There is a potential complication, and it is one of the most significant problems in technical analysis. It is true that there should be follow-through in the direction of previous impulse moves. However, extremely strong impulse moves are more indicative of climax or exhaustion. This is one of the common ways that trends end, so it is important to fully understand these patterns. This chart shows a classic example of a buying climax that ended a trend. A naive trader might have noticed this action and read it as extreme strength. However, in these types of formations, a type of short-term mania sets in as emotional buyers chase the market higher and higher. At some point, the last buyer who wants to buy has bought, and the market becomes extremely vulnerable to a sell-off. The slightest pause or speed bump will send a market like this crashing back into the vacuum on the other side, as there is no more natural buying pressure underneath the market. In addition, there may even be traders who bought into the last trend leg, and they are now the ultimate weak hand longs. As soon as the pattern changes and real momentum emerges to the downside, they will run for the exits en masse, and their selling pressure will add fuel to the fire. Note the classic signs of a buying climax in this example. An accelerated trend rate, large range candle, many free candles, and a subsequent collapse. This type of structure is often called a parabolic move or a blow-off. Notice also that the range of the candles in the blow-off becomes much larger than previous candles as the trend steepens and the candles pull away from the average. This is a reflection of expanded volatility, specifically intraday volatility. To review, some of the most important characteristics of these areas are: usually come after two or more trend legs in the same direction. Show an acceleration in the direction of the previous trend. Many analysts and traders describe this as a market that has gone parabolic. Are relatively infrequent. Usually come at a significant new high or low for the time frame being considered. It is unusual to see climax moves in the middle of a range. Are confirmed by the emergence of sharp contra-trend momentum. If this does not happen, the trend might simply be very strong. Very insignificance. Small exhaustions into previous support and resistance are common, especially on lower time frames, and may not define important structural points for the market on higher time frames.